From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable, and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. Good morning to you. I hope you're doing well. You're ready to start discussing all things retirement matters. In today's episodes, we're going to discuss artificial intelligence and why I think that there is some opportunity in artificial intelligence stocks, although there is a great deal of volatility, and maybe something you may want to consider in your long-term play if you're not yet close to retirement. I also want to discuss tax loss harvesting and how that can impact certain stocks throughout the year, especially as we approach the end of the year. And I really want to discuss with you what the lost decade may have to do with your retirement today. This was the period of time between 2000 to 2010 and some similarities or maybe parallels that we can draw from where we are today in this tech bubble that is surely forming. We want to jump into all of this today and really help you understand how you can retire successfully. Our objective here is to help you as a client. If we partner with you, we want to help you as a client by walking this journey alongside you. We make it very simple, very easy. We are much more than just consultants. We do everything we can to help you take the steps that are necessary to get to the retirement you've always desired. And so many times it has way more to do with things outside of just your investments. We are an investment firm that will help you facilitate the right buys and sales in the stock market, of course. We are blessed to be able to give our philosophy across the nation. We contribute to national publications about how to invest and where to invest and all the things. We're helping shape the news in that arena. But retirement is so much more than just that. There are decisions to be made around Social Security, decisions to be made around Medicare, decisions to be made around whether or not taxes should be something you're focused on and something that could derail your legacy, your kids' destiny, or your kids' inheritance. Also, how do we protect that inheritance against the loss of long-term care expenses? This long-term care expense is something that is taking families' farms away. It's taking houses away. It's taking cars away. It's taking assets, real dollars away from family members. And we are here to help you make sure that doesn't happen to you. By putting the right types of plans into place, I'm confident. I'll tell you why I'm confident. It's because we do it every day. I'm confident that we can help you walk into retirement with more confidence of your own. Walking into retirement with confidence gives you the ability to go impact people that you may have never been able to impact in the past. We talk to people that are do-it-yourselfers. They've been doing it all this time up until now by investing their own money. But there comes a period of time where your life is more about living the life than it is about focused on your money. And if that is where you are, if that's who you are, if you need assistance in making some of these decisions, even outside of the investments that you should be putting to work, we're here to help. We will help you craft the plan that's necessary for you to arrive at the destination in retirement that you desire. We like to think of it as laying out roadmaps for you. And now at the end of the year, it's a perfect opportunity for us to sit down and get together in a one-on-one fashion to where you and a member of our team, maybe a couple of members of our team, are sitting down to discuss your goals, your ambitions, your desires. And as we approach 2026 and even enter into 2026, taking the appropriate steps to make that happen sooner rather than later. You may not be as far away from retirement as you think you are. And it's by putting the right types of plans into place that gives you the confidence to walk into that retirement and impact people's lives around you. We talk to a lot of people who say they wish they had sat down and started this type of planning sooner because they could have made better decisions or made decisions quicker, getting them to the point that they desired in a much more orderly fashion. If that's you, we want to help. 270-600-PLAN. Get in touch with our team or navigate to our website, rdswealth.com. And we would love an opportunity to sit down with you and really start building this plan together. Now, what I want to pivot to is a very quick pause for positivity, which is this section of the show. Every show, if you hear the show, you know that at the very beginning, we want to stop with some positive thought. Just turn off all the noise, all the financial noise, all the news, everything that is so many times trying to beat our doors down with negativity. It's constantly trying to overtake our minds. We want to bring positive thought, and that's what we do in this section. Whether it's a positive news story or just a story in itself that has a positive meaning. This particular pause for positivity is going to be quick because it's an ancient proverb and it's just a saying. But this saying carries so much weight, and it says this: a society grows great when old men plant trees in whose shade they will never sit. Think about that. A society grows great when old men or women plant trees in whose shade they will never sit. This is the time of year where we get to sit down with people who, especially if we're in our 60s, maybe we're in our 70s, we're going to be sitting down with people around our table who we may never see grow into adults. We may be sitting down with people around our tables who we may be able to impact that will reshape generations to come. Now, I'm talking to grandmas and grandpas here. I'm also talking to fathers, moms, dads. No date of death is definite. We are not promised tomorrow. We are promised that we will meet death at some point. And it's the period of time between now and that date that is determined for us, that date of death. It's that period of time that we have to go out and impact the world. And we impact it most by pouring into people who may not actually ever be able to give it back to us. They may never be able to benefit us. But by impacting one person, it could impact the world. I'm a big believer that if we change the world around us, the whole world begins to change. We talk about that all the time on this show as well. But as we go into this holiday season, we've just came through Thanksgiving. We're entering into Christmas and the New Year's. There's going to be some time to sit down and just unwind a little bit. And rather than look at family time as time where we have to sit down with people we don't really know or care about that much, perhaps, look at this as an opportunity to actually impact the people that we love the most. The funny thing is we take those people that we love the most for granted the most. And it should be the opposite way around. I'm guilty of that myself from time to time. And by thinking about this and being intentional, we will be looking for opportunities to impact those people's lives. So I want you to think through this with me one last time, that if we have an opportunity to plant a seed, it may turn into a tree that then grows branches and leaves that provide shade to generations that we will never see, nor will we ever set in the shade that it provides. This is the same equivalent of me saying we're helping people who may never be able to turn around and help us in return. But it changes the world, and it changes lives. And we were here to help change that world one step at a time. Sharing the love of Christ, in my opinion, is one of the best ways to do that, and this is the Christmas season. But whatever means it is that you have to change the world, one small act of kindness is never too small to be done. Do it. Take that step, take that act, and change the world. I'll challenge you to do that with me this week coming and over the next 3 to 4 weeks as we enter into Christmas season. Let's keep this in mind, and let's impact the people around us each and every day. We're going to take a quick break. We're going to reset. We're going to come back, and we're going to discuss this artificial intelligence trade. The stocks in AI are very volatile. They're up and down. They're very moody, if you want to think of it like that. And we're going to talk to you about why you may be okay riding out some of that volatility with some of your money, but you may not want all of it there. We'll discuss this and much more right after the break.
Ladies and gentlemen, this is your captain speaking. Looks like we have about a 72% chance of a successful landing today. Did you catch that? A 72% chance of success? No one would fly on this airline. But you'd be surprised how many people take this approach to their own retirement. This is Dale Smothers, your host of the Retirement Matters Show. Join me right here each week as we discuss ways you can gain confidence in your retirement plan. Good decision-making, time-tested strategies, and a well-written plan will allow you the luxury of relaxation, even when you're going through those panic-inducing turbulent times. As the host of the Retirement Matters Show, we will teach you how to keep your retirement on track, making sure that your destination is everything you wanted it to be.
Check out the Retirement Matters podcast. Just search for Retirement Matters with Dale Smothers on the podcast platform of your choice.
Welcome back to the show. We are in this next segment going to discuss the hot button topic of the market, which is the artificial intelligence trade. And I'm talking about names like NVIDIA, Apple, Google, Broadcom, Oracle. You may have heard of CoreWeave, Applied Digital, all of these names that are just hot names right now in the AI trade. And the reality is a lot of these names have been bid up higher than their profit or lack of profit may justify. Some of these names are not profitable at all, but a lot of investors are optimistic about what they can do in the future with artificial intelligence. And with that, more profit, and with more profit, going ahead to buy those names now, the stock of those companies, buying into those companies now could make a lot of sense later. It could be a way to make a little bit of money or a lot of money in most cases. However, one of the things that you've got to be okay with if you're doing this type of trading is volatility. And I'm not talking about small amounts of volatility. I'm talking about significant amounts of volatility. Let's discuss quickly what volatility is for those who may not be understanding that word. It's okay. It's a very common word in the marketplace, but it's not something we use a lot of if you're not talking about stocks. Volatility is a change. Sometimes you may consider it a measurement of the rate of change, how often things change. If a situation is volatile or a stock is volatile, it's touch and go. It's sometimes up, sometimes down, but never the same. One day to the next, in a highly volatile situation, changes. In a high volatility stock, the price change is never the same. The price of a stock is always changing, high and low. Now, everybody's tickled with positive volatility. If it goes from $70 a share one day to $85 the next, to $95 the next, and $110 the next, and then $135 the next, everybody's tickled with this type of volatility. And we've seen that type of volatility in around probably March, April, and May of 2025 with a lot of these names. Some of these names, even as late as September, had that type of volatility. But the month of October and November, and what appears to be, at least now, most of December, has had volatility in both directions. And some of these names that had a lot of positive volatility, a lot of positive appreciation in their stock price, have fallen significantly to the degree of 50 or 60% less than what it was worth just 2 months ago. So if you had a stock that was worth $100 a share 2 months ago, it may be worth $40 a share now, or $45 or $50. And if you're on that side of the volatility trade, you probably are thinking, should I be selling these stocks right now? Should I be selling them at this point, because we see so many people who buy high and sell low, which is the complete opposite of what you should do in investing. We all know this. You buy low and then you sell high. But when the stock goes higher, aka positive volatility, no one wants to sell. And so how do we measure what a stock is worth? Well, there is the way for something called price to earnings ratio, which requires a company to be profitable to be able to measure that. But these artificial intelligence companies are not price to earnings valued. They're not valued on their stock price according to their profit. They're valued according to what could be their profit, their future earnings to come. And even at that point, some of them are very high. So we look at artificial intelligence as a way to invest into the future because it's clearly the way of the future. We know that artificial intelligence is here to stay and it's changing industries. And we believe that there is likely to be some profit in artificial intelligence if we're buying those names. How much profit is still up in the air. And for that reason, any kind of news that even closely resembles a chance that there may not be as much profit as we thought yesterday, the stocks that rely on future profits will fall. The stock price of those companies will fall. It's only natural. You know, if we were trading on a stock thinking that it would make $1 trillion in 5 years, and it comes out that it's only going to make $500 billion in 5 years, well, that stock price is not worth nearly as much as it was when we thought it was making $1 trillion. And that's where you're going to see these short-term bits of volatility in those stock prices. If you diversify across these futuristic names in the stock market, you are likely to be a winner in the long term. But in the short term, whether or not you are a winner depends on the news cycle. Just like this week with Oracle coming out and saying we may not make as much next year. Well, a lot of things sold off. There were names that had 10 and 15% down days. One day down 15%. That's a struggle. And if you were heavy in those names, you felt that. At R.D. Smothers Wealth Management, we like to have some artificial intelligence exposure, but it is not money that people have to rely on for income. A lot of our clients have nothing to do with artificial intelligence because there are ways to expose yourself to those gains without taking excessive risk. And that is not by buying a name like CoreWeave, for example. You know, even buying names like Apple or Microsoft or Amazon. Those names are trading based off of their future growth with artificial intelligence right now. Knowing what you own and why you own it is a significant part of the battle. Now, I'm talking to those who are 10 plus years away from retirement. If you are going to own artificial intelligence, you have to believe that there will be more good news than there is bad over the next 5 years. And if you believe that there is more good than there is bad to come with artificial intelligence, that's why you would own artificial intelligence stocks. And can you make a lot of money with them? Of course you can. Can you see that money be erased with one bad news cycle? Yes, you definitely can. And so you have to hold these names with conviction, knowing why you own them, why you believe those names to be the best names in the artificial intelligence trade. Diversify enough to where if you're wrong with one, you're right with the other, you still come out okay. And ride out these news cycles. Do not get over perplexed or over anxious about news cycles with artificial intelligence because there will be the good and the bad that comes. And from where I sit, I believe more good is to follow than bad. There will be more good news cycles with mergers and acquisitions and spending and infrastructure build out and profitability than there will be with bad. The bad news will come, and when it does, these stocks will become very volatile to the negative side. But hold out, And with that, I think that it can help make some money. Now, if you're more than 5 years away from retirement, this is good advice. If you are let's say 5 years or less away, let's just go there, 5 years or less away, be careful with AI. Be careful with these high-flying artificial intelligence stocks. At R.D. Smothers Wealth Management, we like to build a portfolio that allows you to embrace the optimism around artificial intelligence without taking the unnecessary risk of the artificial intelligence trade. We can show you how to do that. 270-600-PLAN. Again, 270-600-7526. Or navigate to our website, rdswealth.com. And we can take a look at that together. rdswealth.com. Set up a time to talk to our team member when it's convenient for you, and we'll reach out. Make that a 15 or 20-minute, just a second set of eyes, a quick look at what you've got going on, answer some questions. And with that, I believe the next steps become very clear. We're going to take a quick break. When we come back, we're going to look at the lost decade and why that matters to retirees now. You think, wait a minute, the lost decade, what is that? Maybe you don't know. Maybe you do know. We're going to unpack all of that and more when we come back with more Retirement Matters right after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management, serving the residents of Kentucky and Tennessee. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. We are happy that you're listening in and hope you find value in this week's episode. If you'd like to listen to past episodes and find exclusive content and full-length interviews, search for the Retirement Matters podcast on the podcast platform of your choice, or visit us online at rdswealth.com. While you're there, be sure to sign up for our free weekly newsletter. That website again is rdswealth.com. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. Let's get into the lost decade. What it is, first of all, is the period of time where the S&P 500 finished an annualized rate of return of -1 over a 10-year period of time. This took place between January the 1st, 2000 to December 31st, 2009. It's a 10-year period of time, and your returns would have looked like this. In 2000, you would have had a -9% rate of return. In 01, you would have had a -11.89% rate of return. We'll just say -12. In 2002, you would have been down 22%. These are 3 consecutive years down. In 2003, you would have seen a rebound with a 28.6% rate of return, but you're still nowhere close to even. In 2004, you would have seen a 10.8% rate of return, positive. In 2005, a 4.9% positive. 2006, 15.79% rate of return. And in 2007, you would have seen a 5.49% rate of return. Now, let me recap very quickly. In 7 years, you had 3 negative years, 4 positive years, and you have just gotten back to even, and then boom, 2008 happens. The market finishes with a real rate of return, total return of -37% in 1 year. From January to December, down almost 40% in 1 year. In 2009, we would have seen a 26.4% positive rate of return. And in 2010, you would have seen a little over 15% rate of return, still finishing down pretty substantially, down well below where you started 10 years ago. And this is if you're in growth phase. This is assuming you needed to take no money for income. And this is also assuming that you stayed invested in the first place. Many people end up selling in those lows the first 3 years, down 9, down 11, down 22. A lot of people would have a hard time staying invested. The lost decade took place from 2000 to 2010. We'll just say it like that. It took place because of something called the dot-com crash. This is the period of time from mid-1990s to late 1990s where the internet was coming out and technology companies were being created to help the internet get across the world. These companies were being bid higher and higher. Some companies just simply had a website. Because it was anything.com, it became a valuable company in the eyes of shareholders, and people bought their shares. And the more people bought, the higher the stock price went. Until eventually people realized there's no profit to be made in anything.com. And for that reason, that stock price went to zero quickly. There were some winners. Clearly, Google is one, but there were some serious losers. You ever heard of Ask Jeeves? And in search, Yahoo didn't fare very well either. There were some winners and losers. The losers lost really bad, and the winners have been okay over the last 26 years. However, the late 1990s, if you had retired and needed income, studies show that on average by 2015, you were back either working or you were broke. And this is what we try our best to guard against at R.D. Smothers Wealth Management. We do our best to safeguard the retirees' money that they have made to where when they retire in a good year or a bad year of the market, and God forbid that we have 3 bad years in a row, they're okay. Now, clearly, more good years equals better than okay. But the last thing we want is for someone who has retired with enough money to risk that money and then lose that money and not be able to live in retirement the way they desire. This is why we invest in our retirees' portfolios with a risk-on, risk-off portfolio system that allows them to have money there and accessible for income, whether the market is down or up, without having to sell securities at a loss. This is our proprietary investment philosophy that we use with every retiree, that when they come in and we begin a partnership with them, their investments are built to support their income plan. Not just to grow their money, but to make sure that their money doesn't disappear in another lost decade. This is where we are right now, guys. I can't tell you if we're in the late 90s or we're in the mid 90s, but I can tell you that when the market has bid up this high, it takes one small domino to fall for things to go the opposite direction. For those who are 10, 15, 20 years away from retirement, I'm not concerned. Make sure we pick enough winners in the AI trade, and things should play out okay. But for those who are 5 years or less from retirement, you do not have time to recoup the losses. This is where we talk about losses hurting you far more than gains help you. My team is here to help you understand what it takes to get you through retirement, not just to the date of retirement, but actually being able to live through retirement with extreme confidence and less fear of running out of money. We would like to help you start constructing that plan as soon as you're ready. 270-600-PLAN or rdswealth.com. Let us know when, and we'll reach out at a time that's convenient for you to where we begin this conversation around the retirement you've always imagined and the plan it takes to get you there. All right, just like that, we're at the end of the time, and it flies by every single time that we get together. I want to tell you I appreciate you tuning in to this show. Next week, we hope to bring questions and answers. I'll have a guest on the show, Miss Whitney Eubank, who joins us from our team, our marketing director here. She's going to bring some common questions that we've had sent in from listeners, and we're going to answer them live on the air. And what I'd love for you to do is send in anything that you think you might have questions about. If that's something you would like to hear a little bit about specifics, send them to us. I'll actually give you Whitney's email, whitney@rdswealth.com, whitney@rdswealth.com. Send her the questions, and she'll do her best to get it on the list of questions that we address next week. Until we talk again, whether it's right here on this same station or you pick up the phone and call us and we're able to chat with you in person, always remember, save money, plan well, and live happy in retirement. God bless.
Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. R.D. Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by R.D. Smothers Wealth Management.